Netflix reported earnings yesterday and the stock jumped 10%, taking the company's market value to $418 billion. With $10 billion of cash and investments on its balance sheet and $13.8 billion of debt, the company's enterprise value is $422 billion. This was another strong quarter from Netflix. Revenues grew 16% to $10.2 billion and total paid subscribers grew by 19 million. That was double the number that analysts were expecting. The company has now reported $39 billion of revenue over the past 12 months, $8.7 billion of net income and $6.9 billion of free cash flow, which means the stock is valued at 11 times revenue, 48 times earnings and 61 times free cash flow. Netflix's positive results are testament to a strong product and a competent management team. Management wanted to accelerate growth in 2024 and they've achieved it by cracking down on password sharing, raising prices, bringing in ads and investing in sport. The Jake Paul-Mike Tyson fight in December became the most streamed sporting event in history and more than 60 million viewers tuned in to the Christmas Day Superbowl. Crucially, Netflix still has plenty of growth ahead. The company can continue to move into sport, live events and eventually get into video games. There's plenty of competition in the space, but at this point they seem to be trailing far behind. Netflix's gross margins and operating margins both hit new highs last year of 46% and 27% respectively. Of course, the problem for investors isn't the business, it's the valuation. At $418 billion, the company is valued at over 10 times sales and double the size of Disney. Maintaining that valuation gap is going to require decent growth and healthy profits for years to come. If you assume the company can grow its top-line revenues 15% per year for the next 10 years, while operating with a free cash flow margin of 22%, the company should generate roughly $200 billion of free cash flow over that time. That's less than half the current market cap. A basic discounted cash flow model then puts the fair value at $817 a share, which is about 14% downside from the current price. And that isn't a particularly pessimistic forecast, because Netflix's current free cash flow margin is around 18%, while the company expects to grow between 12 to 14% this year. That doesn't mean that the stock will necessarily fall going forward. Netflix is a quality business with quality management, and they could beat expectations. However, the risk-reward doesn't look attractive. But these are my personal opinions, not financial advice, and I hold no position in Netflix stock. For more investing videos, make sure to visit my website at 3minutebreakdowns.com. Thank you for watching.